Hello, let's start with defining finance. Finance is the study of how people allocate scarce resources over time. Here, resource means a financial asset, including cash, stocks, bonds, and other financial instruments. And over time implies that risk exists in implementing financial decisions because unknown future time we have many well, investors have many unknown risks. Here, people allocate scarce resource. What's allocate mean? Investors use money, use financial resources, or borrow, or invest. That's what we call allocate scarce resources over time. Financial system includes stock market and bond market and markets for other financial instruments, and then includes financial intermediaries. Banks receive our deposit money and then use that deposit money to lend to borrowers. So banks are intermediaries between depositors, lenders, and borrowers. And also insurance companies can be called financial intermediaries. There are regulatory bodies, that's government regulators, including SEC, Security and Exchange Commission. This is kind of police in financial market. They oversight stocks, bonds, and corporations in financial market. The Federal Reserve conducts monetary policies to increase or decrease interest rate. So the Federal Reserve controls interest rate in financial market using discount rate and federal fund rate. Discount rate is interest rate on loans uh, charged by Federal Reserve banks to commercial banks. Federal fund rate is a short-term interest rate among commercial banks. Commercial banks sometimes borrow money from other commercial banks for a short period of time, and then the lending commercial banks charge federal fund rate. We are going to use finance theories to analyze finance market. A finance theory consists of a set of concepts and a set of quantitative models. We are going to In finance market, we have two kinds of market. One is money market. The other one is we call a capital market. In money market, people trade money and highly liquid instruments with maturities of 1 year or less. 1 year or less is called short term. That includes treasury bills and commercial paper. These are bonds with maturity 1 year or less. If one bond is maturing in exactly 1 year, after exactly 1 year, then that is short term. Short term, so that belongs to money market. Treasury bill is issued by U.S. Department of Treasury. Commercial papers are issued by private corporations, large corporations like Microsoft or General Motors kind. And in capital market, people trade long-term securities. such as T bonds. This is Treasury bond issued by U.S. Department of Treasury with maturity of 10 years or greater than 10 years. Greater than 10 years. T-note is issued, bond issued by U.S. Department of Treasury with maturity between 1 and 10 years. Corporation bonds are bonds issued by private corporations with maturity greater than 1 year. And also in capital market, people trade stocks, commercial, where companies issue common stocks, convertible securities, and mortgage-backed securities. Those are traded in capital market. These markets are influenced by interest rate and economic growth and investor confidences. We will discuss these in later chapters. There are two kinds of securities. One is government security, including the treasury bond we just discussed, and then state and local securities. State government and local city or county governments also can issue bonds to raise funds for their projects, including municipal securities or tax-exempt offerings. These are mostly supported by revenue-generating projects. Revenue-generating project can pay back the bond. Well, such as, for example, one county or city want to build a bridge. It takes a lot of money, right? So they want to raise funds to build a bridge by issuing bond. That's a municipal bond. That's called municipal bond or state bond. And then they issue bond, and then they make money. They raise funds, and then to build a bridge. For this bridge, they after constructing the bridge, they charge tolls. That's a revenue generating project, right? And then this revenue can pay back the bond. What does that bond mean? That's debt. It's called debt security. It is called debt security. By constructing a revenue generating project, the county or city government can pay back the bond. That is usually that's the usual bond we see in bond market issued by state or county government. Now let's look at corporate securities. Corporations like big companies like Microsoft or General Motors. Those big companies also issue or can issue bond and trade it in finance market. They issue corporate bonds, and they issue preferred stock, and they issue common stock. Common stock is sold by companies desiring new equity capital. It has common stock holders have voting power, right? Preferred stock holders have right to receive dividend first before common stock holders receive dividend. Who supplies the fund? people, just well surplus people, well such as you and I are households and save money, and then the banks can use that money to buy those bonds also. And companies, well, everyone can be a supplier of funds in finance market. Now let's look at what spot futures in primary and secondary market. Spot and futures. Spot market is where assets are sold on the spot, delivered at spot price. Well, so delivery happens right away, and then payment also paid at that spot price. Futures is where the market where assets are sold at future price set by futures buyers and sellers now. So prices are determined now, and delivery of the products will happen in the future. In the future, a certain promised time, after 6 months or after 9 months, like that. So when it is matured. And then primary market and secondary market here. In the primary market, corporations raise new capital by issuing new stocks. So newly issued stocks and bonds are traded in primary market, such as IPO market, initial public offer market, and then new security market. In the secondary market, people trade already existing stocks, where stocks and bonds, outstanding, already existing securities are traded. So it provides liquidity to investors and keeps the prices competitive, and it keeps finance market active. And they also the important function of secondary market is pricing function. Now let's look at what is derivatives. It is a method of hedging. Hedging means try to avoid or reduce risks. That is called hedging. Derivatives are financial instruments that derive their values from the prices of one or more other assets, such as equity securities, fixed income securities, foreign currencies, or commodities. There are a lot of derivatives. Now, finance managers use derivatives to avoid or reduce risks by using options, futures, and swaps. And then prices of derivatives depends on underlying assets pricing. Underlying assets prices. Let's look at some examples. Let's look at one example of derivative. Let's say option. Option is right to sell or buy assets. That is option. We are talking about the right to buy, right to sell. Let's say there are two kinds of options. Well, call option. Call option is right to buy, and then the put option is right to sell. So call option again is right to buy at a contract price. At a contract price, there is a contract price. This contract price can be determined in the market now. For example, let's say a simple example. your company need to buy oil, but not right now, but let's say after 6 months. And the current price and vertical line shows the price, and horizontal line shows the time. Okay. Now current price is say let's say $30 per barrel. Okay. But your company does not need to buy the oil now, but your company need such as after 6 months. After 6 months. But your expectation on the price is this. Let's say it's going to go up like this. So you expect at that point you need, when you need oil, you need to buy. At that point, you feel such as it's going to be like $50 per barrel. But if you buy the oil now, when the price is low, but it's kind of wasting your money, right? For 6 months. So you want to buy well, call option. Okay. You buy call option now, then at $30. Okay. Buying price is $30 after 6 months, then you have right to buy the oil at $30, not the spot price, $50, right? So you buy that, buy call option here now. After 6 months, if market price, even if market price is $50, you can buy oil at $30 per barrel. Then your company get gain $20 per barrel, right? So this is how a call option works. What if your expectation is not correct, such as instead of $50, it went down actually to $20. It's lower than price now. Then what? Just don't exercise your call option, then that's it. Now, the other side of option, put option. Put option is right to sell. Your company, again, your company need to sell oil. Your company have some excessive oil now, so you want to sell oil after 6 months or 1 year at a certain point to future time, right? After 6 months. And then your expectation is oil price from $30 is going to go down like this. It's going to go down to $20. You're going to lose, right? Your valuable asset price goes down in the future. Then you want to buy put option. So you want to buy a put option to sell your product at $30 after 6 months. Then, even though market price at this time, market price is $20, you still can sell your product at $30. Okay, that's put option. That's how put option works. Now, other ones, forward contracts and the futures. Forward contract is the same, very similar concepts, but in the market, they have very flexibility for forward and they trade in the future. Forward contracts is instruments that obligate one party to a contract to buy or sell some asset, usually crude oil or corns and some food. So asset at the specified price and some specified date, maturity date. So they have a flexible amount of product and then prices, and also some length of the maturity, such as two parties can make contract, such as after next year, such as after 18 months, sell at such as $20 per barrel. Okay. Well, one party buys that, one party, the other one sell the product, right? That's forward contract. Futures has the same concept, but it is standardized. Instead of 18 months, 19 months, or 2 years like that, in the futures market, they have a preset length or preset amount, such as 90 days, 180 days, or 30 days, like that. Instead of here in the future contract, they can say 48 days, they can even 55 days, like that. But in the futures market, they have a preset length of period and then preset amount. Well, these are derivatives. Let's look at organization of security market. When we say security, there are two kinds of securities. Well, actually, this is what we discussed so far. One is equity security. The other one is debt security. Debt security is nothing but bond. If a company will issue new bonds, that's borrowing money from people, right? From investors. Equity security is stock. A company issue new stocks. That means they are issuing. They raise money by selling their new stocks, and then use that money as their capital. Okay. So when we say security, that means basically stocks and bonds. Okay. That security and then equity security. So security markets structuring has changed because of technological advances like market efficiency and profitability. So we trade a lot online, right? So that's what it says. That's why that's what we say technological advances. There are two kinds of stock markets. One is very well organized exchange, such as New York Stock Exchange, and the other one is pretty much it is not pretty much like, well, in New York Stock Exchange itself is a company, so it is well organized. But there are other stock trading networks. It is called over-the-counter market. So many small companies, low-priced stocks are traded over-the-counter market. So New York Stock Exchange is organized like that. Exchange members have seats, this amount, 1,366 seats in New York Stock Exchange. That means, well, this number of companies attend stock exchange. Stock exchange in physically in New York, and then they trade, they offer and bid, and then determine stock prices. Actually, you and I buy a stock when we buy stocks and bonds, we don't go to directly New York Stock Exchange. We go to one of these company, right? Well, such as Charles Schwab has uh, some seats of trading in New York Stock Exchange. We just go to these brokerage companies, right? Well, currently, many people use Charles Schwab and Robinhood, right? You can use that also. Those are brokerage companies. They attend to this stock market. They attend this stock market, New York Stock Exchange, and then determine stock prices, and then the trade. So brokerage companies. Goldman Sachs is a big company. Nasdaq is another big stock trading market. It was just a system that allowed securities dealers to electronically track the prices of OTC securities. It allows companies to list their shares without profits. So Nasdaq focuses on potential growth of companies, mostly tech companies. Stocks are listed in Nasdaq. Stock price indexes. Stock price indexes show how prices of stocks go up and down in market. Stock market, when we know, Dow Jones Industrial Index number goes up, then we can say, big companies in the United States are doing well. So Dow Jones Industrial Index number shows up and down of prices of 30 big companies of the United States. S&P 500 shows reflects the prices of stocks of 500 big companies listed in the United States. Russell 2000 shows the price of stocks of 2,000 medium-sized or small companies in the United States. So Nikkei shows stock prices in Japan. FT30, FT100 shows UK, United Kingdom. So using these index numbers, we can figure out how how much in general stock price went up or down every day. You can just see Wall Street Journal indexes to see the market prices of stocks. Now let's talk about what's market efficiency. we can say market such as financial market is efficient when expected rate of return equals the market rate of return. How come that happens? Well, market efficient market means all related reflected in the market. That's what we say market when we say market is efficient. So all related information is known to market. So people can correctly in the market expect the rate of return. So really that will happen in the market because people in the market knows all related information. So if that really happens, then the market is efficient. So if this is the case, then any derivatives, investing in derivatives cannot make any money because your expectation is exactly the same as in exactly will happen in the market. Such as how can you make money in stock market? Such as you expect, let's say the stock price will be $30, such as tomorrow, and today it is $20. You want to buy that stock and to make money tomorrow, right? If that's the case, you will make money. And then, but if you expect it'll be $30 tomorrow, all other people in the market will also the same $30. Will expect it'll be $30 also, and then people will buy the same price at the same price, and then that happens tomorrow, and you are not actually able to make money then, because today, probably you are not able to buy at $20 because a lot of people want to buy that also. So if market is 100% efficient, that means if all related information is open and known to the market, then making money in stock market by buying and selling is extremely difficult or impossible. So when we say market is efficient, then prices adjust rapidly to new information, and this new information is known to everyone. Because this new information is known to everyone, prices adjust really rapidly, quickly to the new information. And then there is a continuous market. Then we can say market is efficient.